So good morning, everyone, and welcome to this IFT hospitality webinar. So just a few housekeeping rules before we kick off. We are recording the webinar, so we'll send that recording round after. Do feel free to type into the chat box as we go along, and we'll answer any questions that you have at the end. And there'll also be a Q&A element after too, so you can type your questions into the chat box after. I'll now hand over to Lynne Blakey from Evelyn Partners.
Hi there, everybody. Myself and the rest of the panel are really looking forward to talking about all things hospitality with you over the next hour. As Claire said, there'll be time for sort of questions at the end as well. So I'm going to let my esteemed colleagues introduce themselves in a couple of minutes. But for those of you who don't know me, my name's Lynne Blakey. I'm a director in Evelyn Partners, where I work in the advisory consulting team. I'm really interested in hospitality because prior to joining Evelyn Partners, I spent 4 years as FD at the Newton Somerset, which is a hotel, visitor attraction, restaurants, that type of thing. So it's something that's very, very close to my heart and something I feel very passionate about. So I'd like to let my colleagues introduce themselves. So first of all, if I turn to Martin to do an introduction.
Good morning, everyone. My name is Martin Davis. I'm a partner with Graham and Sybil, based out of the Manchester office. We are a large independent firm of property specialists based across the UK, 6 offices in Scotland and 6 offices in England. I'm based out of the Manchester office, and I focus on the hotel and leisure side of the business together with my colleagues there. And we get involved with brokerage, valuation, consultancy, feasibility, building surveys, you name it. Anything to do with a property in a hotel or a leisure property, that's what we do. So I hope you enjoy the webinar this morning.
And then Steve, over to yourself for a quick introduction.
Yeah, good morning, everybody. Steve Crosswell from Synergy Bank. We're a challenger bank with 5 offices across England, 1 in Scotland. Predominantly focused on real estate, but what I do sits within our trading business part of the bank. I'm 36 years in banking, the last 20 of which have been involved in all forms of kind of leisure and hospitality lending.
And finally, over to yourself, Mike.
Yes, thank you very much, Lynn. Yeah, good morning, everybody. Mike Rothwell, Director of Advisory at Bespoke Hotels. For those of you who don't know Bespoke, we are the largest independent UK hotel management company in the UK. We have hotels ranging from 5-star down to 3-star and throughout the country, including 26 in Scotland. My particular role within the group is I don't tend to get involved with the 86 hotels. My role is more of a advisory turnaround role introduced by accountancy firms, lenders and agents. Yeah, delighted that you've all joined us today, so thank you.
Thank you very much, everybody. So there's been lots of well-publicised information around all the pressures in the hospitality sector just now. They are really under pressure from the cost of living crisis, rising cost rates, and also the sort of increasing interest rates, which are now staggeringly high compared to what they were just over 12 months ago. I'd really like to understand, first of all, if I go to Martin, sort of what impact are these sort of economic effects having on the sort of transactional activity within the market?
Thank you, Lynn. Yes, as well as the obvious pressures, which we'll go on to discuss shortly. One of the main problems we've had since the lead up to the Brexit vote has been the lack of stock in the market from a resale perspective. And that's caused a number of issues. Surprisingly, there still seems to be demand from applicants and buyers and funds who want to acquire. But the difficulty we have is that limited stock. So a lot of the transactions that we're doing are having to be off-market deals where we introduce retained buyers to owners who are perhaps sitting on the fence waiting to see what will happen. So that's been one of the problems we've had to come up against. The other issues, I think, will become more clear. I think that there's been a bit of comfort since COVID with the government support, but that as that sort of unwinds and interest rate, people come off fixed term interest rates, then we're going to see some further issues. And I expect off the back of that, we'll probably start to see more hotels come to the market. As I say, certainly there isn't a shortage of people who want to buy. Perhaps the issue is more the kind of buyers who are out there and are able to proceed and who are credible enough with the funding in place, because getting funding is more difficult and more challenging, which again, Mike and Steve no doubt will cover shortly. We've seen the larger hotels, or hotels that are good quality hotel assets. Some niche hotels such as wedding venues have proven to be very popular. Wedding venues because of that foresight on business on the books, deposits up front and fairly firm contracts. That sector has been pretty solid, and we've had a good run of sales in that segment. The market that's perhaps hurt the most are the lifestyle business and smaller hotels, where it's very hard to move on for a newcomer to the market who's perhaps been made redundant from another job and's got some cash to put in. They seem to have found that harder to move those hotels on, or we found that harder to move those hotels on. And as a result of that, we've had to sort of turn over a few stones to help some clients. We've had a number of hotels where larger hotels in areas like the Lake District that find it hard to get staff have acquired B&Bs, acquired planning for an HMO use, and have been putting staff into B&Bs and smaller hotels, which is quite a new initiative. We've also had a number of hotels. We've got a hotel at the moment that is due to exchange contracts next week, which is on the outskirts of Manchester, and that's being bought by a party for a government contract. So there's some of the issues we've been facing, Lynn.
And there's a much sort of discrepancy between what sellers are wanting for their properties and what the buyers are willing to pay. Do you see much difference there?
Yeah, I think that's there's always that balance between buyer and seller expectation. I think that's stretched more than ever at the moment. You know, in a stronger market, buyers have the expectation to pay more. I think because of the pressures and concerns in the marketplace, particularly the uncertainty over where your bottom line is going to end up, which I know Michael will tell you shortly, but with top line numbers looking good and bottom line numbers being a pressure, I think buyers are looking for a better deal, and they need to make it stack up. The traditional multipliers that we use, as in the RICS Red Book method of valuing hotels, is the same. And for a good hotel, the multiplier will be at the upper end of the scale. Poorer hotel with capex issues would be the lower end of the scale. But the actual number after the calculation, given where the bottom line will be, could be challenging for some people.
It's really interesting, Martin. Thank you very much. And we are going to move on later on to talk about some of those operational issues that are affecting the bottom line. Now, Steve, with all these people wanting to buy hotels, there's obviously a need for financing for them. So with interest rates rising, how easy is it for businesses to either raise funds to finance new purchases or actually to refinance their existing debt within the sector? So
if I take a step back to kind of the mini budget, which I think caused an element of paralysis in the market for transactions, and obviously on the back of that, lending. So last 3 months of last year, first 3 months of this year were very difficult. I don't think people wanted to do anything unless they had to, because there was such uncertainty and volatility. And then things did calm down a little bit and then have kind of started to slow a bit. Lenders are still out there lending, but there are less of them. It's obviously more expensive, and what you can borrow is less than it would have been 12 months ago, purely because the ability to repay is that much more difficult. So lenders at the moment are trying to second guess where base rate may go. So if you structure a transaction today, you may use an all-in rate of X% using 5% base, but you've got to try and guess where the Bank of England may move rates. So you end up stressing a transaction probably beyond the point where it actually works anymore, because what you don't want to do is structure a deal today and it fails covenant on period 1 because base rate is now 75 basis points more than it was when you structured it. So that's been a challenge in trying to second guess. Going back to sort of one of Martin's points, I think there's still a gap between buyer and seller because the banks haven't actually been particularly nasty yet. I think lenders have been relatively pragmatic. All the while a borrower is paying their loan repayments or interest, covenants are kind of a conversation piece that people are happy to kind of live with. And the banks are much more or much stronger now in terms of capitalisation, so they are able to withstand a little bit more pain. So I think all of these elements have kind of slowed that potential for distress in the market, which everyone is kind of talking about, and is what buyers are kind of desperate to see, and sellers are clearly not. So a bit long-winded, but it's still a bit possible to lend, but it's much tougher.
And one thing I've been seeing with a number of my clients is that they've been breaching covenants and things like that. And you mentioned covenants earlier on. What's the sort of a bank's approaches to clients who are actually breaching their covenants or getting close to breaching them? Are they being supportive, or are they taking quite strict action on that?
Can only speak directly for ourselves, but anecdotally, hear what's going on in the market. As I touched upon, as long as a borrower is repaying their loans on time, it buys them a hell of a lot of slack. Fundamentally, if we still like management and like the asset and they're still making money, and then Mike will come on to this later, top line revenues, ADRs, occupancy are actually going pretty well. It's the ability to convert that to operating profit, which is really hitting the ability to meet covenants. So as long as we still get a well management, we still rate them and respect them and like what they're doing, and the asset is in good condition and they're meeting payments, they get a lot of time and to work it through.
Very much, Steve. And that leads on very nicely to Mike. We've obviously spoken, both Martin and Steve have spoken about the pressure on the bottom line through some of the challenges that the businesses are facing today. What's your perspective from that sort of operator perspective and what you're seeing in the market?
Thanks, Lynn. Yeah, it's become a really difficult time at the moment to be a hotelier. Not necessarily from the case of generating revenue, and particularly at this time of year, the staycation market is now almost getting into full swing. The fundamental challenge today is converting any of that revenue into anything that looks like profitability. Just from a revenue perspective, those hotels that we've got that are generally rooms driven are doing really well. Room rates are standing up, as Steve mentioned just now, really well across the country at the moment. Most operators have probably put prices up 3 times over the last 12 months. So average rates doing really, really well. And that's only really gone up just to protect the margin. I think the challenge that we've got everywhere at the moment is within F&B. And I'll talk about some costs in just a moment. But making any money out of an F&B operation in a hotel at the moment is really, really tough. And sometimes hotels are doing it just as a loss leader, because if you don't have an F&B operation, it's quite hard to attract residents to come and stay. But from a cost perspective, everything has just gone up. So we all know about utilities. We all know about payroll costs, and as far as payroll is concerned, we used to think that anything that was, as a payroll percentage to sales, anything that was sort of 27-28% was pretty okay. Most hotels I'm seeing now that I'm going into that are in some level of distress, we've got payroll at 40% plus, which is really frightening. Food cost inflation is just bonkers at the moment, and again with food cost, if we go back maybe 2 or 3 years, the average food cost in a hotel would be, I don't know, anything between 27% and 30%. Now we're seeing 35 to 40% in some cases. So again, when you've got costs like that, it's really hard to make anything meaningful. We've also got then those big costs like agency commissions, and I know lots of people here will know exactly what I'm saying when we say that agency commissions are an occupational hazard, but it's a really big cost to every business. So I'm urging all of my owners to invest whatever they can in their own websites, in SEO, to try and avoid this, anything between 15 and 20% agency commission cost, which comes straight off the bottom line. Business rates is another real challenge that we've got at the moment. So as everyone will know, we're enjoying 75% relief at the moment until the end of March next year. We have no idea what the government are going to do come April. And as far as we're concerned at the moment, it's going to go back to 100% business rates. If it does, I think it'll be curtains for a whole bundle of people. The difference between paying 25% and 100% is, in lots of cases at the moment, the profit that hotels are making. So you take that away come April next year, and God only knows what's going to happen. So yeah, it's frightening times as far as costs are concerned. Yeah, I've not really much more to say about cost, really. It's about just cutting your cost accordingly.
Quite a lot of really interesting points in there to kind of unpick. The business rates one's really interesting. Like, we're talking to clients and advising them to get their business rates re-looked at, so that if they do come back, they're in the best position to try and make sure that those rates are as low as they can possibly be, because it is possible to challenge them. The F&B challenge is interesting. And as you say, you kind of need F&B within a hotel space to get people into your rooms. I've seen some businesses where they're almost outsourcing their F&B and getting a sort of chef in or something. Is that something that you've seen in any of your businesses that you're working with?
Not in terms of outsourcing, but the other challenge, of course, within F&B is staffing it. Getting chefs, of any caliber at the moment, or any quantity, is a massive challenge. So there's lots of things that we've now got owners doing in terms of sponsorship for chefs, re-looking at how we do rosters. So, excuse me, moving from 5-day weeks to 4-day weeks in the kitchen. So 4 days on, 3 days off. And that's also having a really positive impact on retention in the kitchens, because I don't know many chefs who'd rather leave somewhere working 4 days to go somewhere else where they're working 5. So a real challenge with chefs at the moment. And of course, when we haven't got the staff, it means even in these busy times, we're having to, close early, close for Sunday lunch. I've got a small B&B client down in the southwest at the moment who's now moved to 5 days as opposed to 7 days, because it's not just chefs, it's also front of house staff as well. So yeah, the recruitment issue, I think, will continue, and we're all fishing in a relatively small pond for a pretty limited number of people. And that's been the case since Brexit. Steve mentioned Brexit just now. A lot of staff that we had before never came back for obvious reasons. So yeah, a real challenge with staffing at the moment.
And despite all that, we've actually had a bit of help, in as much there have been a considerable number of hotels across the country that have taken on government contracts. So they've reduced the staffing in those hotel assets. So has given potentially a local area a bigger pool of people to pull from than they might have done before. But that issue could get worse again as and when those contracts unwind. If some of those hotels do become hotels again, perhaps they might be utilized for an alternative use, but that's another thing to think about. And as I say, there are applicants out there who are sort of still seeking government contract hotels, or who have government contracts and seeking assets to utilize. So that's quite interesting. Going back to Mike's point on F&B, one of the points that I mentioned earlier was the niche sector of wedding venues. Interestingly, we've got a number of clients who've got wedding venues who actually outsource the F&B part of the business. I'm not sure that I would do that, but they do that and seem to be pretty successful at it. There are a number of high-end wedding venues, and they have a good relationship with one source who does their F&B. But that does happen.
Yeah, I mean, I think we've all been to hotels or restaurants recently, and we've seen those staffing issues in practice. And it is something that I think over COVID, I mean, I certainly noticed that a lot of our staff who had maybe been furloughed during COVID just didn't want to come back into the industry. They'd found alternative careers or alternative things to do. So I think that on top of Brexit, on top of the cost of living crisis, really does make a difference. And I hear lots of anecdotal stories about staff literally moving for 50 pence more an hour from one venue to the next. So that must put incredible pressure on businesses and on their margins and things like that as well. Mike, one thing, and obviously with this sort of cost of living crisis, there is a tendency for people to kind of cut back on spend. Now, a lot of surveys sort of suggest that holidays and social activities are one of the last things to cut back. But do you notice a difference between like the business and leisure side of the industry just now and how much pressure it's feeling?
Yeah, I mean, those hotels that we've got around the country that are purely leisure orientated, I mean, they're all doing really well. The conference market has not really fully recovered yet, and I have no idea when it will, because meetings are still happening as we're doing today online, which is no good for hoteliers. So the conference market is really tough out there. The corporate market is starting to recover. We're seeing a lot more transient corporate business around now over the past 12 months, 18 months even. Weddings is a tough one. I know Martin mentioned weddings just now. Lead-in time for weddings is now becoming longer and longer. It used to be in my experience, circa 12 months. It's now more like 18 months where people have to save up for far longer before they get married. Average spend is decreasing. I think I read some stats from wedding dates the other day that 52% of weddings now spend under £65 a head, and about 12 months ago it was only 43%. So 10% more weddings now are spending less than 65 quid. And I think it also said that 50% of couples now spend only 10 grand on their wedding, excluding the honeymoon. But that's not a lot of money, you take the VAT off that, and there's not a lot left when we talk about making profit, and payroll cost at 40% and food cost at 35%. There's not a lot left, really.
And that leads on quite nicely to a point that Martin had mentioned earlier on about a number of hospitality businesses seeking out these government contracts to just now, which are a little bit more lucrative, potentially. Mike, have you noticed some of your sort of businesses or people that you've been working with trying to do that, and does it make a difference to the bottom line?
Oh my God. So I think at the moment there are about, I think the last time I looked, or last thing I read, about 500 hotels around the country at the moment with government contracts in place, housing something in the region of 50,000 asylum seekers, something along those lines. Now, we all know that Rishi wants to reduce that and wants to shut the hotels and put everybody onto barges in the sea. I can't see that happening anytime soon. I've got a client at the moment up in the northwest who is currently speaking with Serco and the agent about moving a property from normal trade to a government contract, and far from the government saying we're not doing that anymore, we might nearly be there with it. And this is a hotel that's only 50 bedrooms, circa 50 bedrooms. If we do nothing with that hotel for the next 12 months, it will make, if we're lucky, zero. It'll wash its face just about if we do nothing with it. We've done the fag packet calculation for the government contracts, and worst case scenario, it'll probably produce an EBITDA of 1.2 million. So it's a game changer as far as stakeholders are concerned. And I think that will continue for the next 3 to 5 years. I just can't see, when we've got more asylum seekers than ever coming in, we're never going to have an opportunity to close these hotels and move them somewhere else. I've got another client in the Midlands who has a 60-bed hotel, has been doing a government contract now for past 2 years. That was a hotel that was making little or nothing, and he's now turning over 3 million quid and making an EBITDA of 2 million quid. Yeah. And that £2 million a year is probably worth more. It's probably more than the hotel's worth if he was to put it on the market. So once that contract comes to an end, he's probably just going to say, fine, I'll sell it, for a song or apply for change of use.
Right, and that raises 2 points for me. The first, if I can come to Steve, is around funding. So how do lenders feel about this? Because it is potentially a limited period, and how do they feel about funding businesses within, with those government contracts in place, or looking to go into those government contracts?
It's mixed. Some don't mind it, some don't like it. I mean, we're probably in the latter camp. We've got some existing customers that have taken on contracts, and as Mike said, they are hugely profitable. I mean, we've got some people who've got 120, 140 bed hotels. So just using Mike's example of a smaller one, you can only imagine what these people are making. The risk for us in terms of new to bank propositions is the end game. So I think the longer these assets have contracts in place, the less they become a hotel. And the longer it's in place, the more you have to do a bigger relaunch. I think, you've got the CapEx issue. Clearly they can afford it because they've got a lot of money coming in, but you've got the CapEx, you've got maybe a rebrand, a reposition, local stigma around what this asset has been for a few years. So we've just taken the decision not to do any more new business in that area, purely because of the unknown risk of the relaunch at the end of the contracts.
Yeah, and the other thing, of course, is you may have had, corporate guests staying at a hotel. And there's quite a lot, let's face it, there's a lot, they're not just small independent hotels that have taken contracts. There are corporately branded products out there. And there may well have been corporate guests that have moved to a hotel down the road, and you're going to have to, if you want to reopen it as a hotel, you're going to have to try and attract them back. They might have been well looked after down the road. So the goodwill issue, I think, is something to bear in mind. But it's a difficult, if it were your property and you were struggling to break even, and there was the opportunity to make a big profit, that's something you've got to consider, depending on your circumstances and your business mix.
So what was interesting, Martin, is yesterday I came across a hotel where they were doing asylum seekers and normal hotel guests side by side. So I got a call from a friend who said a friend of theirs had booked 60 rooms at a hotel for their daughter's wedding at the end of July. And they'd gone on TripAdvisor to look at the reviews, and they were horrified to find that, all these stories about asylum seekers and security guards. So yeah, I don't know how that would ever work, doing those two segments side by side, but hey.
We've come across some as well, but some seem to make it work. There's some very good operators who've been, using some big initiatives for helping their residents in terms of getting them busy and doing things and getting involved in the community. So there are some good stories we've heard of, but there are also some horror stories too.
And Martin, do you find that investors are looking to actively invest in businesses who have those sort of contracts in place, or is there a nervousness around that?
No, I think it's a very small end of the market. As I say, I've got a hotel that's due to exchange contracts next week to a party that are going to close it down as a hotel and convert it. They've got a government contract in readiness and going to take it that way. I think they've had to put a lot of cash in themselves, and I think the additional piece of funding they needed was via a bridging loan rather than a traditional method. But they've got a number of other similar assets around the country. So I think, that's.
And one other thing that's been that I've noticed a lot recently is this move towards, and quite rightly so, towards kind of ESG and to making everything more sustainable. There's both a consumer pressure for it as well. And I've also seen some lenders looking for sort of extended ESG sort of credentials and things like that. Is that something that you're coming across, Steve, much?
It's definitely on the radar. We're only a small bank. It's on our radar. We've launched kind of EPC friendly loans on our resi part of the book. The bigger banks have clearly got the resource to put proper products and teams into launching these things. So it's not going to go away. It's only going to kind of gain momentum, and rightly so. I think, you know, one consideration is when you've got funds looking to buy hotels is that they've got a 3, 5, 7 year hold horizon. Is that, you know, you fast forward 5, 7 years, the ESG agenda will only be more prominent. So these people want these assets to be as ESG ready as they can now, thinking further ahead as when they want to exit for a premium.
We're seeing that in terms of talking to funds on the larger assets and the corporate hotels, that, you know, they certainly are looking at those factors, and that's an important mix for them to be showing their investors that they are being, you know, responsible. We've found as a business that it's something we've followed up. We have a carbon and sustainability team, and you know, it's certainly something we were talking, Mike and I were talking about this the other day, in terms of, you know, there's lots of things you can do to a hotel to make it more more friendly, but, you know, there's still the physical cost and the capex involved in that. So it's not just about changing over to some LED bulbs, but quite a lot of factors, which no doubt Mike can, where he's had some clients that he's been advising, that could be an issue.
I mean, it's a really interesting,
save money if you've got the capex in the first place.
Yeah, absolutely. I mean, and it's interesting, you know, it's only in the last 12 months where I've been speaking to any of my owners about ESG. But, you know, when you're dealing with a hotel that's in a significant amount of distress and they're worried about paying the payroll bill next month, the very last thing they want to talk to me about is ESG. It just becomes way down on the priority list, and they know they have to do it. And so we try to come up with initiatives that they can do that's going to cost them nothing. I mean, nothing's ever free. So, you know, we have to come up with things that are affordable to them, that puts them in a really good light with the general public. You know, and you know, even just applying for, you know, a green certification that they can put on the website just to demonstrate to people that they are doing stuff proactively is a really critical thing to do. You know, and we're doing lots of stuff around the hotels now with you know, as Martin said just now, you know, LEDs, and but as soon as you do that, you know, you've got to change transformers, and what becomes a really, what you thought was a cheap project becomes then something quite significant. But there are water saving stuff that we can do. You know, we're changing now all the mini plastic bottles in bathrooms into wall mounted containers, just to get rid of all those plastics. You know, all the plastic straws are gone, and takeaway boxes in plastic, all that kind of stuff. So there's lots of stuff that we're doing. But again, you know, particularly from my side, when I'm dealing with distress and turnaround and recovery, ESG is probably low on the priority list at the moment.
It's very high on the agenda of the consumer, isn't it? So it's an added challenge to operators already pushed for costs, is that consumers are ever more demanding in this area now.
Yeah, absolutely.
And I think it's one of those things, Mike, that, you know, as we work with clients, you know, all four of us really, when we're advising clients, and, you know, they're in a difficult situation and you're helping them through it, and, you know, we talk to an owner operator and we'd introduce them to somebody like Mike or an operator to help them through the trading part, is dressing that business up and building it for sale at some point in the future. So you need to look at future proofing it, I think, and that's certainly something, if you can do that. Otherwise you'll be looking at selling it at, you know, the lowest possible price. So if you want to maximize your return and get out of it, then you want to build the value back in.
Yeah, I mean, it's an extra cost, isn't it, for businesses that potentially can't afford it as well. And a lot of businesses recently haven't really invested that heavily in their assets as well. So it's an additional cost on top of that, really. Makes it a difficult time. I want to make sure that we leave enough time for any questions. But what I would like to do is follow up with the panel. Just one sort of final question is around, is there any other sort of key challenges for the sector that you see coming in the next sort of 12 months that we haven't really touched on? And if so, what can they do about that? If I could start with Mike first, sorry to put you on the spot, Mike.
No, that's okay. I think everything that is going to be a challenge is already happening to us at the moment. All I will say is I don't think it's going to get better anytime soon. You know, we've got more payroll cost coming with further increases next year in national living wage. We mentioned earlier, business rates is a massive challenge, or may well become a massive challenge come April next year. The staffing thing ain't going to get easier soon. So yeah, as I mentioned earlier, I think it's just a question now of running down the hatches. And I can't read the future. I don't know what's going to happen now with interest rates. Are the government going to step in and help us with VAT? I doubt that very much indeed, but you know, we can keep everything crossed on that one. How long is the war in Ukraine going to go on for? Nobody knows. So there'll be more things around the corner to come, I'm absolutely sure. But we're still here, you know, and we're still trading. There aren't many hotels in crisis at the moment. Actually, it's interesting, when I'm speaking to some of the business support arms of the banks at the moment, they're still telling me we've got more coming out of business support than coming in. So that's a real positive. Again, long may that continue.
Yeah, I mean, I think those rising costs, I think hotels and businesses have been quite successful at passing them on. Just now I've seen sort of average room rates and things go up, but there must come a ceiling at some point where people just don't have the cash or aren't willing to pay anymore with it. Martin, have you got any sort of final comments or thoughts on the challenges for the sector?
Yeah, I think over and above that, I think it's not all doom and gloom either. I do think, you know, I've said for a number of times over the last number of years, I thought once the Brexit vote had been held, that some more hotels would come to the market and we'd get more transactional activity. And then lo and behold, we had a global pandemic, and then we've had all kinds of shenanigans. But I do think that we will start to see some more hotel stock come to the market. I hope that vendors get a little bit more realistic in their pricing expectations, and I think there are people out there to do deals. You know, we're doing deals. You know, there are some companies out there who've done a really good job over the last 18 months, 2 years. You know, we've come across groups like the Inn Collection who've bought a number of hotels from us, who've emerged really quite quickly and got quite a good model. And they've gone for the inns with rooms approach, and that seems to have worked very well for them. And they sort of acquired a good number of hotels, and they're still on the warpath for more. We've seen the regional brewers have been quite active in terms of acquiring hotels. So yeah, I think it's not all doom and gloom, but I think it'll be interesting to see how things play out with interest rates, and you know, how the banks eventually will look at that. I don't know. I hope that they carry on taking the view that they seem to have at the moment, and you know, work with people rather than see the carnage we saw in 2008 or in the late 90s, where suddenly a load of stuff was thrown on the market and there's a massive price correction, but there's a lot of pain for some people, and it's their livelihoods. We're the IFT. We need to be helping clients and helping them turn their businesses around, and we want to be selling them successfully to good operators and carrying on growing businesses that way.
Sort of leads on quite nicely to yourself, Steve. So are banks going to continue to be supportive, do you think, in the current climate?
I'd like to think so. I mean, given what's happened with COVID, and we had about a 15 to 18 months, actually quite decent period of trading until kind of last autumn. So it's been a very challenging 3-4 years for everybody, and lenders, I think, have behaved pretty well during that period. And it comes back to what I said earlier, the fundamentals. If people can meet their repayments and they're cooperative, and we still believe in management, then there's a story to be had, and there's a workaround to be agreed. So I'd like to think that the sins of kind of what happened after the global financial crisis, you know, what won't be repeated. I think, you know, banks are in a better conditioned to withstand some pain as well. I think one of the things I think you touched on earlier was the two things that people try and uphold the most is their holiday and their social activities. But I guess people rolling off of fixed rates having to refix is kind of what impact that may have on discretionary spend. But hopefully that's more of a drip feed than a flood.
It's certainly impacting some of my spending decisions just now. Yeah, no, thank you all very much for your time. I wanted to leave a little bit of time, so 15 minutes for any questions at the end. So could I just open up the floor to if there's any questions from any attendees?
So we do have quite a few people still on the line, so feel free to type your questions into the chat box, or if you want to raise your hand, we can come to you as well. The questions can sometimes take 30 seconds or so to come in, so we'll sit tight.
Yeah, just while we're waiting for questions, Steve, I'd like to just sort of say on your sort of last point, we are seeing a number of businesses whereby they've had quite a lot of debts in COVID and they really just need to restructure facilities. And the one sort of advice that we are giving them is to speak to the banks, because we are noticing that banks have been quite supportive just now. It's kind of the usual story, give much advance notice, get people involved as early as possible and bring them into board. But it really does seem to be bearing fruit just now for people if they are having those conversations early.
And that's right. A lender doesn't want their back to the wall. They want to have an idea of what the situation is, and then can work out any potential options to resolve that. If you're kind of given, a gun with one bullet in it, then it's not particularly pleasant as a lender, and you end up looking after your own interests rather than maybe the wider interests. So I think, early dialogue and transparent dialogue is vital.
So if you do have any questions, feel free to open your mic. If not, we'll give you the 16 minutes back. Okay, so thank you so much to the panel. That was great. Obviously, very, very well rounded, as we don't have any questions currently. We have a thumbs up from someone, so they definitely enjoyed it. So thanks everyone for attending. We'll be sending round a recording of the webinar, so expect that to come into your inbox shortly, and we'll see you at our next webinar.
Fantastic.
Thanks everyone.
Thank you very much,
Thank you.
everybody.
Thank you,
Thank you
everybody.
very much.
Bye-bye.
Bye.